Good morning, everyone, and welcome to today's webcast, Growing Your Winery, Understanding Your Key Financial and Operational Metrics. We're actually experiencing some technical difficulties in our Santa Rosa office that Bill is presenting from. If you could just bear with us for a moment, we hope to get started any minute now.
Hello, this is Bill.
Hey, Bill. All right.
You're there.
Step one. Okay,
I'm
so
trying to get
we have everybody logged in, so everybody can hear us talking. So we're just going to go ahead and get started like we discussed on having Emily advance the slides.
Okay.
Okay. So welcome, everybody. Thanks for your patience. Emily will kick us off by introducing Bill. And again, thank you for your patience. We're trying to work around the wonderful world of technology. So thank you.
Thank you, Kelly. Like Kelly said, I am pleased to introduce our speaker today, Bill Vyenielo, Senior Business Consultant at Moss Adams. Since 2006, Bill has been working with wine business owners and managers to solve a myriad of operational and planning challenges, while also helping them pursue their goals. Utilizing experience gained in successfully developing and managing winery operations and building brands, he is adept at providing guidance in strategic planning, sales and marketing, winery, and vineyard development. And Bill, I will now turn the line over to you.
Good morning, everyone. Today we're going to talk about growing your winery, really looking and understanding at your key financial and operational metrics. So bear with us. We're getting working through the technical difficulties with this, but let's advance to the next slide that says what we'll cover today.
All set.
All right. So one of the key things whenever you're running a winery is really having a plan that everyone is aligned with. And in line with that will be all of your financial projections. What we're going to talk about today will be looking at the key financials, the balance sheet, the income statement, the cash flow. Balance sheet is really going to cover what you own, what is owed against that, those assets. The income statement, it's really a non-cash picture of how your company's doing. Cash flow, in our business, that is the king of all statements. It's how we run our business. It's really the lifeblood of running a winery. We'll look at a financial scoreboard. That's how, it's kind of a unique look at how the financial statements fit together. And then we'll take a look back at how you can use historical financials to establish a good sense for trends, costs, what drives your financials, what the key performance indicators are that are helpful to review and keep tabs on. I've also put together some management report examples that we'll be able to go through, and then talk a little bit about benchmarking, what the benefits are of that, and then we'll look at some of the technologies that are out there to help you integrate systems. And ultimately, the goal is to be able to use these types of tools to look forward as you're forecasting the future direction that you're hoping to hit with your goals. So let's go to the next page.
Okay.
Start with a plan.
Yep.
Okay. So just from my own experience, give you a little example of a story. When I first started running a winery called Peter Michael Winery many years ago, I asked Peter, what did he want long term? And his response back to me was, Bill, I'm European. my benchmarks are Bordeaux and Burgundy. We think we can give them a run for their money. We want to be very small, but we want to be very high quality, and I'm building something for my grandchildren. So for me, task was running the winery and building the team. It was a very clear vision on what the long-term goal was. We had to maintain quality. We had to continue to look for ways to improve that quality in a very competitive environment. And we weren't looking at monthly financials and quarterly balance sheets. We were looking at a very long-term goal. Again, he was thinking generational. So whatever the plan is at your company, that's going to be the driver for what your goals are. And often it's going to end up dictating how you perform. So we'll look back at financials, cases sold, revenue, cost of goods, gross profit by product, expenses by department, whether that's in the tasting room, the wine club, your traditional 3-tier sales department, admin. We'll also talk about some of the key performance indicators to look at in each one of these areas and really know why it's important to know, for example, what items are fixed costs, what items are variable costs. Not too long ago, I had a client come in with a break-even analysis for their winery, and their target was about 7,000 cases to hit break-even. And what we did do is we went through the numbers, and I started breaking things out on a variable cost basis and a fixed cost basis. We reran the numbers, and it showed they were going to break even at about 12,000 cases instead of 7,000. So all of a sudden, the whole conversation changed, and we went back to the drawing board and took a look at their product mix, we took a look at their pricing, and we looked at their standards for forecasting in the future. So it became a real great situation where they got a much better understanding of how their company runs. With variable costs, they're going to move right along with the growth. Fixed costs, as you increase your volume, you're going to be able to cover those more with increased volume. But what they weren't taking into account was how much of their costs were variable. Let's go to the next slide. Balance sheet.
Okay.
Yeah, thank you.
All set.
Great. So what this is balance sheet is a snapshot in time, whereas the other statements are not. This is just where are we today, what assets do we own, what liabilities do we owe. It's going to help tell us, is the company solvent? Do we have sufficient liquidity to pay our operating bills, to make payroll? And it really gives you a good idea of what are the assets, where they consist of, who's got a claim against those assets. And what it doesn't tell us, what a balance sheet doesn't tell us is, did the company make money last year? Does it have a healthy cash flow? What you really are going to be using a balance sheet for, where it becomes valuable, is when you take two balance sheets from two different periods and compare them, because that's when you can measure your progress between those two dates. If you're going to a bank to secure funding for a loan, this is certainly one of the first financial statements they're going to ask for, and some of the things they look at are some of the ratios. They'll look at how much debt you have versus your equity or net worth. And what they'll also ask for is a profit and loss statement. So let's go to the next page, the income statement. And
okay.
A lot of times people think of an income statement as we made money. You look at the bottom line, or we lost money, or you made money. This is a very simple income statement, but it's really here to show and tell us over a period of time, in this case it's a 12-month window, what happened during that period. Did the company make money or not over in that period of time? It's only going to track the agreements and the promises that were part of the company's transactions, not what you collected in cash or paid out in cash. So it's really a look at the contractual aspect of your business, what you agreed to do, what promises you made to pay, what promises your customers have made to deliver to you. So if you look at the income, it's essentially saying, did the sales income that we derived from the products that we delivered, sold, does the sales income exceed the cost of providing or making them? So that's regardless, again, of whether we've been paid or whether we've paid our suppliers. And really one thing that I find oftentimes is cost of goods sold. It's really important to get a good handle on this. What some people think of cost of goods sold as is what they spent on making wine this year, and not really understanding that what it represents is the cost of making the wine that was sold during this period of time. So that, again, it's what did it cost to make the products that were sold? That's your cost of goods. And if we go to the next slide, we're going to get into the cash flow statement, which is really the pivotal statement to really manage by oftentimes. Oftentimes with an income statement, it looks like you're generating money, you're generating profits, but you can still run out of cash. So are we on the cash flow statement now?
Yep, that's live.
Okay, thank you. So I just made the statement here. This is something you cannot do without. The most critical aspect of running your business is managing your cash. So every year, profitable companies go out of business, and we wonder how can that happen? And because they really didn't have enough cash to stay in business, they were, you can hear the term sometimes, they grew broke. So they grew faster than they were able to collect cash from their sales activity, or collect cash from a banker if they weren't able to finance it. So key thing here is, you can operate for a time without profit, but you cannot operate a day without cash. And what the cash flow statement is going to tell us is what cash came in and went out during a specific time frame, what do we pay our vendors, and what we got paid by our customers. Now, the format of this statement is broken out into, on the left-hand side, you'll see O, VF, ICF, and FCF as you're running down the left side. What I did is break things out into an operating cash flow area, an income, an investment area for your cash flow, and a financing area for your cash flow. So it's really important to know what your cash flow is from your operating activities, because over time, that's what's going to be generating the cash you need to run your business. Investing is helpful when you need help, say, investing in capital improvements, such as maybe a winery expansion, equipment, other things. But that is really oftentimes for a short-term influx of cash that you're going to eventually pay off through your operating cash flow. Cash flow from financing, that is your borrowings from banks or from investors that are investing in the company. And so it's really important to understand the difference between the operating cash flow, investing cash flow, and financing activities cash flow. Let's go to our next statement, our next slide, and we'll take a look at how these three financial statements fit together.
Okay.
It's called the financial scoreboard, and it's a little different way from looking at the interrelationship between the different financial statements, and found it really valuable for, especially if you don't have a background in finance or accounting. You may be a great winemaker, may be a great manager, but understanding the essentials of how these statements fit together is really, really valuable and really important. So here's one way to look at these side by side from left to right. A beginning balance sheet, say in this case, it's the start of a new year or the end of the previous year. Got the income statement and a cash statement, and then the end of the year balance sheet. So for last year, 2015, if we go from left to right on this, you can actually generate a cash flow statement if you know your beginning and ending balance sheet and your income statement numbers. If we start with cash and work our way down, you can see on the right-hand side, I put a little cheat sheet of, for example, cash. That should be what your beginning cash is, plus what the change in cash during the 12-month period should match what your ending balance sheet says. Now, if you just forget about that line and we're able to work on all the other lines, all the changes in those other lines should match and show what the change in cash is. In this case, I've got a very simple cash flow statement. They have a change in cash of $5,000, a decrease of $5,000. Look at receivables. This is one of the most important areas to manage in a business. We start off beginning receivables plus what we sold off our income statement. What do we collect? That's coming off of our cash flow, and that should match with our ending receivables. So you can either take the beginning receivables plus sales of $500,000 here and subtract collections of $470,000 to end up with a remaining receivable of $30,000. If you wanted to create a cash flow statement and you knew your balance sheet beginning and ending, all you'd have to do would be to take your sales minus your outstanding receivables, and that should show you what your collections are. Inventory, we think about what we started off with, the balance of inventory we started, plus the cost of goods that we sold. You're going to subtract that because that's inventory that's moving out. You're going to pay cash for inventory, building your inventory, so you're going to add more to your inventory value, and that should match what your ending inventory is. So anyway, you can get the sense from moving from left to right horizontally, you can see how each one of these lines interrelates from the start of the year to the end of the year. What belongs on the income statement? For example, you got your sales, cost of goods, depreciation, amortization. You'll have your expenses, marketing, sales, general and administrative expenses, and the interest, income taxes. So going vertically down the page, you've got a complete income statement. You can see that your net profit in this case is a loss of $17,000. And then you can also use this type of format to see what type of return on assets you had. And in this case, they had a simple negative 7% return on assets with their loss. So that was the net profit against total asset value. On the cash flow statement, if you go vertically down the page, if you forget about the change in cash and review all of the items below it, the net effect of all of those should show that there's an operating cash flow, in this case, a negative $16,000. We didn't invest in anything during this period, so there's no investment cash flow. They borrowed $11,000, so there's cash that they took in. So the net difference between the operating cash flow of a negative $16,000, add back $11,000 for your financing, and you've got a change in cash of negative $5,000. So that matches what's up at the top line. So one rule of thumb to remember when you're looking at balance sheets is on the very bottom here, I put a DAILS, decrease in assets, increase in liabilities. There are always a source of cash. So if you're decreasing your assets, you're selling off assets, you're going to be collecting cash. If you're increasing liabilities, you're borrowing money or you're taking money in from investors. So it's, again, a source of cash. On the flip side, increasing assets, you're growing, for example, your inventory. That's going to consume cash, the use of cash. Decreasing liabilities, you're paying them off. That is your use of cash. Let's go to the next statement. So we're going to look back 3 years, side-by-side financials, balance sheet, income statement, and we're going to take a look at some of the trends in the respective functional areas of the company and get a better sense for why they're important. And I'm going to have to pull this up on my screen. Here we go. Okay, so let's go to the next page.
Okay, and this should be a PDF that will open in a new window for everyone. Just a reminder that when Bill is done addressing this, you'll need to hop back over to the presentation on the tab on the left.
Right. Okay, so is it up now?
Yep, it's live.
Great. So we just looked at some really basic, simple balance sheets, income statements. And what I did here was put 3 years of balance sheets and income statements side by side. And with a goal here that we're going to take a look at some of the key drivers and standards that the company's operation can develop based on your sales and expense activities. And really, they become the basis for measuring your progress and making plans that are really grounded in reality. So when you take 3 years, what I wanted to do here is think of this top section as an input section. It's an input for the balance sheet. I keyed in the information, put in the information for 3 years worth of income statements. Again, a very simple income statement. But scrolling down past the net income area, there's some additional info that's valuable to have. Looking at your accounts receivable, really, really important to manage this area in your business. These are pretty typical reports to kick out. Looking at your receivables, what portion of them are current, what are out 30 to 60 days, what are out 60 to 90 days, and then over 90. You may have some history on it with bad debt, depreciation, repairs and maintenance, and then annual principal payments based on the level of debt you have. So, and then other information to key in or to collect to help analyze the dollars, the financial dollars that you get out of these reports. The thing that makes these valuable is when you match them up against operational information such as your production, your units of production, whether it's tons, gallons, purchased, cases bottled, cases sold. All this information is what gets costs broken down to, for example, a cost per gallon or a cost per case basis. And when you're going from year to year to year, that's when you start looking at these standards and being able to compare and see trends from one to the other and identifying where things may be going, maybe improving, where things may be going the opposite direction, and you need to drill down and find out why. So in this case, I put in examples of what information on a gallon standpoint, cases bottled, cases sold standpoint, tons grown, producing acres being farmed, what acres are pre-productive or not in production yet, being developed. Also bottling, another important area of production. And then so I took all this input information and did a trends analysis, and this is really where I wanted to go, is looking at trends analysis and ratio analysis. In this case, we had a fairly large winery, 80,000 cases produced, 100,000 cases produced, somewhere in that range a year. The production versus sold, are they selling at the same rate they're producing, or are they selling at a slower rate than what they've produced over the prior year? If you're growing rapidly, it's not uncommon to see that cases produced to be a larger number than cases sold, but it's certainly something to be aware of. As you're growing, that it's very common to have a need to secure an operating cash flow or an operating line to help feed your cash flow as you're growing. And in a situation where a winery may be more mature, the production and sales are in line, growth is leveled off, that's the period where a winery is oftentimes kicking off a significant amount of cash. But during the growth phase, that's not the case. All the cash that you're typically generating, any surplus cash you're generating from sales is going right back into inventory and helping grow your inventory. Anyway, here's some examples of areas that are really helpful to look at. If you're analyzing trends, your production, your sales, both in a unit basis and a dollar basis, you can look at your average case price. You can look at what's the percentage change in your wine sales. Looking at your cost of goods sold, really pivotal number. For me, one of the first things I often look at is what's the gross profit as a percentage of sales, and also on a per case basis. But your gross profit, or also called gross margin, as a percentage of sales, is a real barometer to use. If you're not above 50% in our wine industry, it's really tough to survive. 50% is a real barometer, and I'd say that typically it's very common to see wineries at 55 to 60%. If you're a smaller winery and you're able to sell a lot more wine direct to consumer, it's certainly not uncommon to see a gross margin or gross profit as a percentage of sales above 60%. Other areas that can be expensive and are important to be tracked are really looking at your marketing activities. You can break that down on a cost per case basis. You can look at it on a marketing cost as a percentage of sales. Same thing with administrative expenses. Again, it's just some good examples here of benchmarks you can establish for your own operation, and over time will help you identify areas where you can make some progress and track how you're doing versus previous performance. In production, when you're farming, sure, it's important to look at tons per acre, really important number, but one of the things I like to hone in on is production costs per acre. Farming per acre tends to be fairly fixed, doesn't usually move a lot on a per acre basis. So once you've got your costs dialed in here, these can be really valuable numbers and to use to project what it's going to cost you to farm in the future, whether that's the current existing vineyards or whether you're planning to do a vineyard development. You can use this type of information to come in with some projections that are really grounded in reality. So anyway, these are just some examples. You've got cost per, what's your grape cost per case work out to be? What's your grape cost per gallon? These are all helpful standards to have when you're working again toward making some projections and having some trend lines for the last 3 years to look at. Again, these give your numbers some real validity when you're making some forecasts. We go down to receivables. Managing your receivables is really important. It's not uncommon to look at these receivables on a weekly basis, especially if you're in the middle of a high cash flow period, barrels being purchased, grapes being paid for, or you're in the middle of a wine club and sales are in a very active mode. So looking at receivables, days outstanding, you can often compare this to your payables. How long are you on average taking to pay your payables? You can compare these two numbers and see how closely aligned they might be. If you're paying your bills every 30 days and your receivables are out 60 days on average, well, you're letting some of your customers use your money for a while. So you can think about trying to get the accounts payable and accounts receivable time periods more in line, and that can really make a big difference with your cash flow. Inventory ratios. This is really looking at, say, inventory turnover. That's your cost of goods sold. A way to calculate that would be what's your cost of goods sold in a year versus your average inventory value. You can do it on a dollar basis. You can even do it on a unit basis, like cases sold divided by the case equivalent of your inventory. But given the fact that we have very slow turn inventory in our industry, we don't typically turn our inventory more than once a year. It's very common to see the numbers that we're seeing here, 0.3 inventory turns per year. So in this case, probably looking at a winery that has a 3-year inventory cycle. So maybe they're producing a Cabernet. So it makes a big difference on the type of wine that you're producing, on what type of inventory turnover you're going to have with your company. But inventory management is one of the biggest issues within our industry. Is I think people getting a good handle on that is always a challenge. And a lot of people come from outside of our industry and invest in it and find out just how important it is to really know and understand the impacts of building inventory. Liquidity ratios, these are ratios that your banker will often look at. Current ratio, current assets versus current liabilities. Quick ratio would be your highly liquid assets versus your current liabilities. So I don't think of inventory as being highly liquid. So it might be included in the current ratio as a current asset, but in a quick ratio, you're going to be really looking at your cash and receivables as the most liquid assets versus your current liabilities. So debt service coverage, all these are really, really important numbers to know ahead of time. If you're walking in to talk to your banker, it's very reassuring to the banker if you have this information on hand or are already very familiar with your company's ratios like this. You can look at your return on assets, good operating expenses versus sales, return on equity. Both return on assets is your net profit over your assets, return on equity, net profit over your equity. And leverage, again, bankers will look at this, the leverage ratios, especially the debt to net worth ratio. Very important when it comes to having numbers organized for your bank. So I'm ready to move on to the next slide here, if you can please move it.
All right. And just a reminder for everyone, you can click out of the PDF that's open here or just move over to the tab with the presentation in it. And the next slide is live, Bill.
Thank you. So we've done looked at some basic accounting reports that are really vital to running a business. Now what I'd like to do is look at what types of reports from a management perspective that you can use to really deliver the big picture that you're striving to achieve when you want to understand how's the business performing. So I've put together some examples, and one of the things that I wanted to do, the first one is titled Management Report of Sales Performance. Are we on that page now?
Yep.
Thank you. So if we look at, we talked about a 3-year trend. In this case, I put 2 years of actual on the left-hand side. So where's the company been for the last 2 years within these case sales? What percent was sold direct to consumer, DTC? What's your total revenue been what your gross profit looked like, what your gross margin, in this case, very good gross margin, so over 70% a year, average price per case, average cost per case, and average gross profit per case. So we're looking at year-to-date, YTD column to the right. It's always valuable to compare how are we doing this year, year-to-date, versus the prior year, year-to-date, and how are those numbers different? How do they vary? And what's the percentage change, percent variance? Usually when I see a pretty significant variance, that's always the first flag that means you need to dig down and peel the onion a bit to find out why. What are the driving forces behind that variance? But this is for a manager one way to quickly glance at key areas in the sales area to get a sense for some things you may need to take a look at. So year-to-date versus prior year-to-date, important to look at how are we doing. Next, I like to compare the year-to-date versus the year-to-date budget. Where do we expect to be, and how are things varying from that? So again, looking at variances, drilling down to finding out the why behind it is what you're going to want to do when you're reporting to a board or an owner, or helping your team figure out how to respond to a variance that is favorable or not favorable. And then also getting a sense for where you're at year-to-date versus where you expect to be at the end of the year, the annual budget. And in this case, they're already over their annual budget on sales. Cases sold are 102% of where they expected to be versus their budget. So they're doing pretty well. So this is just a quick look in the sales area. Let's go to the next slide.
Okay.
Management report, case sales trends by channel. Whenever you can use visuals such as graphs or charts, they are so much more effective oftentimes at delivering what's really happening and good overview of what's happening. So I've just found that oftentimes when you can use visuals, the conversation, if you're meeting with your team or an owner, it frees up the conversation to talk more strategically, because you're not sitting there studying a spreadsheet. You're looking at a picture and you immediately can comprehend what it's telling you. So in this case, in this winery, the channel sales by tasting room, by wine club, by their e-commerce cart, and some other DTC activities, and then their wholesale activities, you can see the breakout in terms of case volume for the last 3 years and then partially into 2016. So if we put those side by side within each sales channel, you can see the tasting room sales. If I'm looking over at the graph on the right, they've been increasing nicely for the last 3 years. And I did a quick analysis to show that might they end up the year 2016. At the rate of sales, the tasting room appears to be on track to hit 4,000 cases at the end of 2016. So that was going to eclipse any of the 3 years previous sales. So a nice 13% increase. If we look at the wine club, for some reason, the wine club sales initially appear to be declining, but with drilling down through the why, I found out that some of the wine club sales were mixed in with the e-commerce sales, and so the initial thought that things look like they're declining was not an accurate finding. We found that we had to combine the two to really get an overall view on how they were doing on the DTC side between the wine club and the cart. Sometimes this happens when you're changing software. You may have one software that captures the e-commerce information and another software that's capturing your wine club information, and then they're not integrated. So these things happen when you're changing systems at times, and that's what happened with this winery. On the wholesaler side, what they were seeing here is both on the wholesaler sales to distributors in this case, were on decline. And there was some decline with their broker sales between 2014 and 2015, but they changed brokers, and they were seeing a nice positive response through their new broker. So anyway, visually, this conveys what's happening much more quickly than just a bunch of numbers. So again, just encourage everyone to learn how to use graphs. I just did this in Excel, and it can be very, very helpful to when you're trying to convey meaning in a meeting. Let's go to the next page.
Okay.
So this goes back to a couple slides to the same format where I had 2 prior years history, prior year-to-date comparisons, year-to-date versus budget, and year-to-date versus the full year. In this case, we're looking at a little bit more detail by sales channel. So you can do this for multiple brands. You might have 2 or 3 brands under one winery's operation, and you can use the same exact format for every brand, and you can take a look at cases sold, price per case, revenue within each one of these channels, and develop a lot of helpful metrics. Average price per case in this situation is a really valuable one to see, obviously, the difference between pricing within the different channels. Your retail, as we all know, is top of the line is going to be about twice that per case of distributors and wholesale export pricing. So again, just a suggested format that I found really valuable over the years. Let's go to the next slide. Same format. This would be the same format. In this case, looking more at some of your key expenditure areas, but more importantly is looking at items as a percentage of sales, and each of these items, whether they're sales or expenditures, on a per case basis. Because again, thinking of developing trends, these are the types of costs per unit, revenue per unit numbers that create the foundation for making really good projections. So again, items at a percentage of sales, this is gross margin as a percent of sales, year to date, 74%. It's the same level that they were at in the prior year, 74. Year before that, they were 71. So they've seen a nice improvement, very healthy profit margin for this winery. Administrative admin expenses as a percentage of sales, sales and marketing expenses as a percentage of sales. It's pretty common to see admin expenses around 11 to 15% as a percentage of sales. Sales and marketing expenses are typically higher. They're often in the 20 to 25% percentage as a percentage of sales. And again, these are some examples. Oftentimes we'll look at EBITDA, and here a number we hear thrown around a lot. Sometimes it's good to look at it on a per case basis. So if people are looking at winery sales at times, the EBITDA number is often used as a multiplier. It's kind of a barometer on what potentially the value of the winery could be if it were to be sold. Let's go to the next page.
Okay, and Bill, just a reminder, we have about 15 minutes left.
Great. So just some quick looks at some of the metrics you can look at in different areas of the winery. Your tasting room, your wine club. These are some examples or suggestions on some of the things that you can track as a manager on a month-to-month or quarterly or annual basis. Next one.
Okay.
Okay, so this is management report. Again, the power of using visuals. In this case, we're looking at a wine club. What are the sign-up rates, what are the cancellation rates, and what's your net growth? Again, it's so much easier to tell what's going on from year to year within this winery's wine club. New sign-ups are outpacing cancellations, and so you can see the net effect outpacing, showing a positive growth rate there. Let's go to the next slide.
Okay.
Again, just you can use this format for almost any area of the business. In this case, again, some examples of things you might track on a production, on the sides of production with tons crushed. What does that mean in terms of case equivalents? What types of what gallons did you produce? Gallons per ton, a really, really important barometer I've found over the years. It's a quick way to read how things may be pressing out during harvest. And sometimes I've actually had experience where we were pressing out at a lower gallon per ton basis than I would expect, and then went and talked with the winemaking team to find out why. So sometimes it could be they may have changed some the pressing cycle may have changed, the pressures they were wanting to use may have changed. It could be the year, maybe small berries, low yields. Just again, these are good just establish good barometers to help you quickly assess what's going on within the operation during your busy day. So next page.
Okay.
So what we've talked about to this point is to really help you look at what standards is your company establishing, given the actual performance over the last 3 years. The next thing to look at is how does your operation compare to the outside world, other peer wineries, other similar operations. And in our industry, it's really challenging because we don't have access to that type of information. I think over 90% of wineries are privately owned. So let's take a look at the next slide, please.
Okay.
So winery and vineyard owners, oftentimes I hear this all the time. We think we're doing a good job managing our winemaking and our selling costs, but how do we know if we truly are? On the vineyard side, we know our farming costs, we know our yields, we believe we're working efficiently, but how do our yields and our costs compare to similar operations? Good questions. Let's go to the next slide.
Okay.
So this is the information. Is really find someone with access to industry information, whether that's Moss Adams or another firm or an association. It's really, really helpful to know how do your costs compare to a similar operation. With Moss Adams, we have a dedicated wine industry team. We really know this industry well. We have over 300 winery and vineyard clients throughout California. And also we're into Oregon and Washington, so we have access to this type of information. And we're also active with a lot of wine industry associations. So given permission to utilize a winery's information, we can confidentially develop a real apples-to-apples benchmark comparison tailored to a company's performance against similar operations. And I can't tell you how valuable this is because I've lived through this and found out how valuable this information is. I put together an example of how you can use this information. Let's go to the next slide, please.
Okay.
So many uses for benchmarking. I just put together, for example, you can look at crop yields per acre, your farming costs per acre, per ton, per case, revenue per case, gross profit margins. It's really unlimited, the different areas. It's just really limited to your imagination. You can apply this to almost any area of your business. How do you use this information? What can it help you do? It can help you make better pricing decisions. It can help you get a sense for what sales channel mix to target. Should we increase our direct-to-consumer more? Should we work more on our sales with our distributors or brokers? You can identify areas where a reduction in costs are needed. And really, if you find that your numbers are stacking up similar to industry standards, then that's pretty reassuring to know that, okay, we're running fairly efficiently, we're doing well. And also, it can bring into focus areas that need improvement. So I'll give you an example here. Let's go to the next slide.
Okay.
What information do I need to provide I had a client come to me and say, we think we have farming costs. We know them, but we don't know how they compare to the outside world. And so here's the type of information that we needed to really find a true apples-to-apples comparison. Excuse me. So in this case, we looked at what county, what AVA, how old was the vineyard, what was the size of the vineyard in terms of acres, how many of those acres were producing, what variety was being farmed, how densely planted is the vineyard, how many vines per acre are you farming, is it a similar trellis type, what type of production you're seeing off that vineyard. And then these are just good examples of what type of operational information is important to have on hand to then be able to look at the costs, the expenditures of farming. So let's go to the next page.
Okay.
This would be showing you what types of farming cost information we'd need to provide. So whether that's you've got your vineyard payroll, your vineyard management company, all these things that are direct farming costs. I like to break them out: direct farming costs versus your overhead, sort of your general and administrative costs for the vineyard that you might allocate to the vineyard. Let's go to the next page.
Okay.
So really the summary is a quick summary on the benefits of benchmarking. It can help you identify specific things to improve. It can show you where you have competitive advantages that you might look at leveraging. Maybe your yields are really good, your quality is really good, and that's a competitive advantage. From the peace of mind standpoint, if you have an independent third party that you know knows the industry well, has access to really good information, and you sit down with them, maybe you're a president or general manager of a winery, and you and the owner sit down, or the board sit down with a person that can tell you how your operation is performing against similar peers. It's really, really reassuring from a general manager or president's perspective to hear that information. It's also the same goes for president, because oftentimes you as a president or GM might be telling an owner or a board one thing, but to have it come out of the mouth of a third party and reinforce some of the things you're saying, it's just really reassuring for an owner to understand from a third party, independent, no bias, to really get a true sense of feedback on how is this company doing, how's my management team doing. Let's go to the next page.
Okay.
Here's a real life story that I wanted to bring up. I had a client, they had 9 vineyards, 300 acres, Sonoma County, Russian River, Sonoma Coast, mostly Pinot and Chardonnay. And they were like a lot of us, they're trying to have a strong, sustainable winery and vineyard business, really respected for the quality of their grapes and their wine. So in the ultra premium segment of the market. So they're paying a lot of attention to every aspect of their farming, very precision farming oriented company. Go to the next page.
Okay.
We took a look at their cost per acre, and we broke out their direct farming costs. We dropped out the things such as overhead, property taxes, and looked just at what their farming activity, what did it cost. So on the left here, these are the client's vineyards. In the middle, we have the minimum in blue, the average in red, and the maximum of all the comparable vineyards. So when we stack this up side by side, we could see that they're, in this case, the client's farming costs are at or below what the average of their competition is, of their peers. We go to the next slide.
Okay.
Yield per acre. We took a look at this. Again, client's vineyards on the left. The average in red, 3.25 tons per acre. As compared to the clients, 2 tons per acre on average. So they're a ton to a ton and a quarter less than the average of their peers. So all of a sudden, we have one important factor to be taken into consideration here. And let's go to the next slide, which is we did a calculation. What is their cost per case, the direct farming cost? Because their yields were lower than their peers, what we found was their peers, on average, the cost of farming, the cost of producing their grapes was $73 a case. And you can see the clients' vineyards are all coming in, most of them are coming in closer to $100 or even over $100 a case just for the cost of growing their grapes. So big eye-opening result from doing this analysis. So what did we learn? Let's go to the next page.
Okay.
When they came to me, they thought that their vineyard management company was charging them too much. We found out that that assumption was wrong. They were being charged a fair market rate. What the issue really was their crop yields. They were much lower than similar vineyards, and this meant that their grape cost, farming cost per case, was about $25 per case higher than their peers. So right off the bat, they were at a competitive disadvantage going into the market just based on the cost of the grapes. So the result of that is they kept their vineyard management company, and they shifted their focus to their viticultural operation to see how could they increase their farming yields, their crop yields, while maintaining their quality. Let's go to the next slide.
Okay.
We talked about looking back at historicals, really getting a good handle on your internal numbers. We've talked about benchmarking against similar companies. Now, what I found to be really, really valuable is to look at ways on how to integrate your information. It's a really common dilemma, trying to make sense from separate data that's maybe in an accounting system, a wine production system, a wine club, and tasting room systems. It's not uncommon for wineries to have 2 or 3 systems all running independent of one another. So look to leverage technologies that integrate data and systems because it can be a true game changer. The savings in time and labor typically were expended every month for extracting data, analyzing data, and putting into formats that then go into a report for management. They take so much time. And if you can find the right systems, you can do this in a fraction of the time. So tremendous improvements in efficiency, tremendous return on investment. Some integration options that I see out there, Vin65 in the direct-to-consumer world, or Simply CMS or Captina. There are others. These are just some of the ones that are becoming, I think, able to integrate information across the wine club, the tasting room, and the shopping cart. Excuse me. So really, really, really a time saver there. And there are some categories of applications called business intelligence applications. One of the ones that I see being used very effectively in our industry is called adaptive insights. And the nice thing about it is it can collect data from systems you already own. So it can generate management reports, and it can make budgeting and reforecasting very fast and much easier to do. So right now, let's go to the next page, the current scenario, how time is often spent.
Yep.
Oftentimes in the financial world, you're spending half of your time compiling information, trying to get it to and maybe only able to spend 20% of your time analyzing the financial performance of your company. With some of these new technologies, excuse me, you can turn this upside down, spend a lot more of your time in the high value area of understanding your financial performance and being able to look forward when you're managing your company. Next page.
Yep.
So adaptive insights, it's another, just as an example, You've got much better visibility on how your company's performing, so you're able to make faster, smarter, better decisions that are going to help increase your revenue, decrease your costs. Automating a lot of these manual processes eliminates the chance for errors, whether that's double entry. It helps reduce the need to use Excel, as most of us use it very extensively, but we often find it's prone with errors in our spreadsheets, and it's very, very common to have those issues. It can help you with your compliance, and obviously it saves time and money. And the nice thing about it is it's able to integrate a lot of applications like QuickBooks or Excel or NetSuite, Salesforce, Navision, all into one common database that pools and stores data. So not just the year's current information, but you can archive historical information to develop trends that you can then analyze. Next slide.
Okay.
So this is a kind of a quick little graphic where we're headed. Oftentimes where we're at in analyzing our information is we're driving a car, but we're actually looking back and getting a sense for where have we been. And what's nice with some of these applications is you're actually able to get information, make much more timely decisions, and use that information to look forward and drive a company forward as opposed to looking back. So doing rolling forecasts is very easy to do now in Adaptive Insights, and the wineries are putting that to very, very effective use. So next page, budgeting and forecasting. Just an example screen of what an Adaptive Insights screen may look like in the budgeting world. What I'm hearing from users that have been using the system for 2 years, a year and a half, is they're finding much greater teamwork, involvement, engagement in doing the budgeting because it takes less time than their old Excel spreadsheet process. And because it does look a lot like Excel, it's fairly easy for people to pick up and understand. And so when it comes time to do reforecasting, people are more inclined to jump in and do it and get engaged in it, as opposed to having to slog through another series of Excel spreadsheets. This is a very, very powerful intelligence application. Let's go to the next page.
Okay.
Anywhere, anytime, any device. This is a cloud-based solution, so you can connect to this from anywhere you have internet connectivity, whether that's your phone, your iPad, your computer. They have very, very powerful dashboards and reports that you can generate from the streams of data and numbers that we all know we can generate. But this puts it into a context that helps you make decisions quickly and to see trends quickly. Next page.
Okay.
Some wineries that are currently running Adaptive Insights. Some of these are larger wineries, but the nice thing about it is these costs, for example, of running a business intelligence application, are really being driven down. And for example, I asked Adaptive Insights, what would it cost a small winery? And the response was about $15,000 for a 2-person license a year. That's less than half the cost of an accounting department person. And you can, as you've seen in maybe the previous slide, it's very, very powerful in terms of the types of reports it can generate. And you can just piggyback it on top of systems that you're already running, your team already knows and uses. And yet, from a management perspective, you can tap into that, stream that data into a system like this, and get really, really valuable information to help you run your business better. Next page. Any questions?
Okay.
I cannot see because of our technical difficulties, I can't see any questions right now. So.
Oh, I think you covered about everything. We're just about out of time. Bill, do you have any closing remarks?
Well, whatever questions we do have, we're happy to follow up and provide answers to you after this session. But I hope that any of you with any other questions, feel free to contact me. My contact information should be on the next slide.
Yep.
And hopefully that we can help you in some way. Thank you.
Excellent. Thank you, Bill. And thank you, everyone, for your patience while we work through our technical difficulties today. We appreciate you joining us. We do have a link to an online survey here where you can provide feedback for today's presentation. If you could take a moment and complete that, we would appreciate your feedback. And thank you again for joining us, and we hope you'll join us again next time.